I appreciate all of you being here today. This is the typical disclosure. We're here to offer any securities. Trading involves risk, and we got to all stay focused in that direction. I'm going to show you several trades today. We're going to talk about our core strategy. Before we talk about that and how we apply it, you will be seeing real trades that we've taken in multiple trade rooms that we host, where you see any testimonials from students or copies of trade sheets. Obviously, the names have been redacted to protect their privacy, but these are all real, vetted, documented, real trades that we handle. I have three learning objectives here today. One is to familiarize you with what we call the Globalization 3.0 capital markets trend as we look at them through the Online Trading Academy model.
Hey, John, I don't mean to interrupt, but we can't see your screen right now.
Oh, wow. What do I need to do to screen share here then?
There should be a prompt that allows you to share your screen. There we go. Rocket.
Okay.
Yep.
So my goal here today is to introduce you to Globalization 3.0. What do I mean by that? My job is to give you a cursory view of our core strategy, which happens to be patented, and how, if you apply it, it very well may change your life, at least your trading life, but you need to apply it with discipline. And then my other alternative here today is to invite you to a free class that will be hosted near one of our centers across the world. So let's get into this. One of my mentors was a guy by the name of Alvin Toffler. He's a futurist from the late 60s. He's written a new book called Knowledge Power. It's on Amazon. And he made the statement in his new book recently that the illiterate of the 21st century will not be those that cannot read or write, but it will be those who cannot learn, unlearn, and relearn. And I think that really is applicable to trading. Trading magnifies the fact that we all have a belief system, and we come to the party to express a belief system. Sometimes the belief systems that we've had or internalized are not factual. Some of them are basically myths, but they are very dynamic and have a fantastic impact on the results of our trading. Now, if I were to ask you, one of the most important things we ask here at Online Trading Academy when newbies or seasoned veterans come into our space to develop a relationship is, why are you here? And I think it's very appropriate that you ask yourself, why are you interested in trading? You have a lot of things that you can do with your life, your time, your talent. Why are you interested in trading? And a lot of people on a very surface, superficial basis will say, I'm interested in making money. Well, of course, everybody's interested in making money, but that I think it's what I have seen in the 17 years that I've been here at Online Trading Academy is that it's a much deeper reason on why you're seeking trading. And it might be the lifestyle. It might be that your job is stressful. It might be anything on this slide here. You feel concerned about all the outsourcing going on, and in fact, you could lose your job. Most of the people that we run into who are baby boomers don't have enough money to retire. The Department of Labor put out a statistic here recently that 63% of the baby boomers, 70 million of us coming through the pipeline, have less than $25,000 in savings. 32% of the baby boomers have less than $1,000 in savings. So that's a real serious condition, because you're either going to become a ward of the state or a burden on your children unless you get busy to raise some funds to finance those golden years and chapters of your life. So we find people come to us for two particular reasons. One is for weekly income, either as a supplemental conduit, and by the way, I'm not recommending anybody here today give up their day job. I don't think that's prudent. I think you can fit trading part-time into your lifestyle, especially with the automated entries of your trades. We call it set it and forget it trading. Some of you would, I'm sure, aspire to make trading and investing your primary source of income. If you put a lot of energy into it, you may evolve to that. But then a lot of us, of course, have a reason. They've accumulated a nest egg, and your primary motivation is not necessarily daily income, weekly income, but you want to protect your pension plan from the next bear market cycle. I'm not going to give you a big sales pitch on Online Trading Academy. You can go to tradingacademy.com and click on the About Us link, and you will discover we started in July of '97. I'm not the founder of the company. I'm one of the pioneers that's helped build the business, however, because I started with the company as a principal in January of '98. But we were started as a broker-dealer in Irvine, California, with 180 traders executing a little over $500 million a day as a day trading arcade. 2 weeks before 9/11, we converted our model into being a school, and we have become the largest trading school in the world. We have 36 brick-and-mortar centers all across the world, and we're now in 7 countries. We also partner with all the major exchanges. Many of the direct access brokerage firms outsource their education work to us because that's our specialty, and we're very proud of that. So let's take a look at the markets and what do we mean by Globalization 3.0. This is the S&P in nominal price from 1970 through 2000, and take a hard look at that one period of time where the blue arrow was located, which was from the start of 1987 through 2000. That little 87 crash kind of looks like nothing but a little annoying road bump, doesn't it? But if we take a look at the market today, it happens to look remarkably different. The previous chart is a classic definition of a secular bear market of long-term duration, and buy and hold would work quite well in that environment. But let's take a look at where the market's been since 1997 on the hard left edge to where approximately it's at today. Now, the Dow closed today, by the way, down 265 points at 16,945. The S&P closed down 32 points today, down to 1965. But at the end of the day, our vision of the future is that this is what the future is going to look like, a continuation of this pattern in front of you. I call it the W pattern. At the end of the day, we think there will be some modification in that we think the peaks going forward will be higher, the valleys lower, and we think the cycles are going to get closer together. In other words, we think going forward there's going to be more volatility and wonderful trading opportunities in the Globalization 3.0 environment, which we'll define here in a moment, than what we've seen in the previous chart. So let's take a look at how we come to some of these conclusions. Whoops. If we were to look at that movement in price, note that the S&P is priced in nominal dollars. Well, so in order to figure out the purchasing power parity of 1 unit of the S&P, what we need to do is multiply the nominal index by the dollar index. Now, the dollar index, symbol DXY, is the price of the U.S. dollar against a basket of peer currencies who are our trade partners, heavily weighted toward the euro. But you can see from 1913 at the advent of the Federal Reserve System, the dollar has lost 97% of its buying power. So if you are one of those individuals that has 100% of their income, asset, long-term wealth, short-term wealth, dollar denominated, which is very common if you live in America, but I'm sure we have people on this webinar from other parts of the world, you can see that dollar-denominated assets have not been a very good store of value. And really, that's what trading and investing is about. Now, this is the S&P Composite Index, not the S&P 500, but it's monthly adjusted for the Consumer Price Index. Now, I think most of us believe, rightfully so, that the CPI is manipulated and adjusted for political propaganda purposes. But let's take a look since 1870, what's happened to the 3 globalization periods. We would call from roughly 1800 through well, approximately 1900. Let's call that Globalization 1.0. Globalization 2.0 really starts at about 1900 and ends at around 1980. That'll be Globalization 2.0. And I'm going to, actually 1989 is the ultimate marker. We'll talk about that in a moment. But the Globalization 3.0 is this period of time between 1989 and where we are today. And these are long waves of price movement, and we are in the relative early stages of Globalization 3.0. And we think, and we'll make some assumptions here about what the future might look like. But regardless of the innovation cycle, regardless of what political party was in power, and regardless of whether we run a fiat standard or a gold standard, you can see that the equity index, the number one equity index in the world, the S&P Composite, has fluctuated wildly from periods of overbought to periods of oversold, and neither extreme of overbought or oversold was ever sustainable. But look at the devastating size of these bear market, secular bear markets that came along, and look at the duration of length of some of these bear markets from peak to trough to break even. 263 months, 350 months, 289 months. Now we'll talk about where we are in just a moment. But therefore, this is why it's imperative that you be a meticulous risk manager to avoid these drawdowns and get out of your buy and hold bias. This is another indicator most of you have probably never seen before, and this is a different way to measure the stock market, is using as our denominator not a nominal dollar, but using the nominal GDP. In other words, this chart is asking the question, if I were to take the combined market cap of the New York Stock Exchange, add it to the market cap of NASDAQ since 1924, and then divide that by nominal GDP, I would come up with a price ratio. And the red line, C, is the average, which is about 63% of GDP. So if I take all the peaks out and all extreme peaks out that turned out to be unsustainable, and all the extreme bottoms out that also turned out to be unsustainable, I can see what the average is and see where we are today. I want you to note right here that the ultimate extreme was in March of 2000, right here, where the markets, the equity markets, were valued at 180% of GDP. Now, remember that the S&P, the Dow then was about 11,700, and the S&P was at about 1,500 in March of 2000. And of course, where do you think the markets are at today? Well, take a look at this. Where the markets are at today after the extreme bear markets of 2002 and 2008, the markets today, even with a roughly 17,000 Dow and roughly 2,000 on the S&P, the markets today are only trading at 125% of GDP. So what we think is happening is this. We are in a secular bear market that started in March of 2000. We're still in it. If we were to connect these higher lows, these lower highs and lower lows, it looks to me like since 2000 we have been channeling back to the red line, which is at about 63% of GDP. And ladies and gentlemen, that's about 50% lower than where we are today in nominal terms. And by the way, we would call that mean reversion under traditional technical analysis. So we think we are still in the secular bear market and we are trending lower over time. Now, another indicator that we like to use as what we call an odds enhancer to our core strategy is the New York Stock Exchange Margin Debt Indicator. That is, what is the irrational exuberance to use credit or debt or leverage to participate in these bull and bear markets? Well, one of the best, most efficient ways to measure that, which is published every Saturday, which is the Margin Debt Indicator, and it's published in Barron's. This goes back to 1997 when Online Trading Academy was founded, and on the left axis we're looking in red at the nominal S&P, And on the right axis in blue or turquoise, we're looking at the margin debt balances as a percent of GDP. And you can see there is a very high correlation that when we get up in this altitude of somewhere in the vicinity of about 2.8% of GDP, that is as margin debt, corresponds very nicely to a peak in the market. Now this is where we are today. This is the most current situation. And the market today is telling us that we are at an extreme peak, and there is high probability of very substantial correction that we believe is coming. Now, another way to measure the S&P in valuation extremes is to take a look at ask a simple question: how many grams of gold does it take to buy 1 unit of the S&P? And what we've done here since 1880 through today is do a simple calculation. We take the nominal S&P divided by the nominal price of gold expressed in grams of gold, and you can see that our really peaked in really around 2000. And we are nowhere at all close to a new bull market. Now there's another way that we can do the math, and we'll talk about in a moment, which is to multiply the S&P by the dollar index and take a look at what the purchasing power parity of the S&P is today versus 2000. But what is going to usher in this continued bear market? We believe it's going to be a credit purge cycle. This chart we get from the Federal Reserve System basically measures nominal debt outstanding in the public and private sector as a percent of GDP. And you can see, starting right here in around 1980, how we really started to see cumulative debt grow at a much faster rate than GDP. I want you to note that this has been growing with almost no downtrend at all since 1953. But take a look at the hard right edge of this chart today. Starting in 2006, we have started the purging cycle. Now, we can debate whether we're going to have a purge cycle like we had in the 1930s or not. The jury's still out on that. But there's no question in our mind that we are now well into the purge cycle, which will precipitate household leverage ratio continuing to decline over time. This is the household leverage ratio going from 1955 through today. And we're basically looking at the ratio of household debt to wages and salary income. And you can see it's very clear that the markets have turned over and we are now in the credit purge, or what many call the deleveraging cycle. The U.S. government has about $17 trillion of debt outstanding on their balance sheet, but what is not recognized, unless you look at the footnotes of the balance sheet of the U.S. government, is that with Social Security and Medicare and the gap between what they expect to collect in funding and payout over the next 30 to 40 years, we are really in an additional $200 trillion in debt when we look at the gap between the expectation of tax collection and disbursements. So we really have a very serious challenge in front of us, and so does Western Europe, and so does Japan. So our theme in Globalization 3.0 is this credit purge cycle. It is going to continue to play out. It is going to create lots of price volatility in the capital markets and a lot of rich, abundant trading opportunities. This since first quarter of 2003 shows you how total debt has slowly been deleveraging for the American family. So what's that led to? Very anemic growth, and our civilian labor force participation rate is tragically very, very poor. And again, this is after the government and the Fed have thrown over $7 trillion at the challenge, and we don't have a lot to say for it. So how are you and I going to build and protect our wealth in an environment like this? Well, I want to talk to you today about our core strategy It was developed by, and I want you to write this gentleman's name down, Sam Seiden. You might want to do a Google search on Sam. He's our Chief Education Officer here at Online Trading Academy. Joined us about 8.5 years ago and has had a big impact on our business. And it caused us, with the support of our 80 instructors that are on our faculty, to give us an audited body of work that is the core strategy for us to make high probability buying and selling decisions in all time frames with multiple asset classes. We were recently granted a patent by the U.S. Patent Office for our core strategy. To my knowledge, it's the only patented core strategy in the trading universe anywhere in the world. There are many other strategies out there, but none, to my knowledge, have taken the time and expense to acquire a patent. Why did we do this? Because if you know anything about the patent system, you should know that you are never guaranteed that the patent will be issued, and you are never guaranteed that the patent will that it will be issued. You have no idea what it might cost you or how long it might take. So we were rather bold and heroic, I think, in taking the time to get our core strategy patent, because we did this to protect the intellectual property so that the graduates of Online Trading Academy could use it to make high probability trading opportunities. Now, we use our core strategy to trade stocks, bonds, options, currencies, and futures. There are many rich trading opportunities out there, and our core strategy, regardless of what you want to trade and the time frame you want to trade, our core strategy works remarkably well, whether you want to produce income or you just want to protect your long-term wealth. So I'm going to start to show you a few charts here. If you're more of a longer-term trader, you might want to use some of time frames with one-day candles. But if you're a day trader, you might want to use shorter-term candles and not take the overnight risk. And again, regardless of what you aspire to do, our strategy will work quite well for you if you're willing to follow with discipline. Now, there are many mistakes, but the biggest mistakes that investors and traders make, one of the very biggest mistakes that the nervous novice herding public make, is really not understanding how the financial system works. Now, it's not your fault you don't understand it, because it's not like Wall Street's going to teach you how it works. It's not like you're going to get it through a traditional academic exercise at a university. It's not like your broker-dealer is going to teach you how to trade. You're going to have to get it in the private sector from a specialty educator like Online Trading Academy, and there are others out there that do a pretty good job of teaching you this skill. But if you'd like to learn our core strategy, you're going to need to try it here, because we're the only one in the world that teaches what we teach and how we teach it. One of the biggest mistakes I think investors and traders make is being exposed to the mutual funds. We're not big advocates of mutual funds. John Bogle wrote a scathing indictment of the mutual fund industry. He made the case, and some of you may know him, he's one of the pioneers in the development of the mutual fund industry after World War II. He makes the case in his most recent book that if you had invested $10,000 for 50 years and it grew, or if you invested $10,000 for 50 years and it grew at a rate of 10% a year simple growth, at the end of that 50-year period of time, you'd have $1.17 million of cumulative gain. But then he says, well, the mutual fund company needs to take out their 2% per year compounding fee structure. And that's the difference between simple growth and compounding growth, is that the fees on that kind of performance takes it down to about $700,000. In other words, you've supplied 100% of the capital, taking 100% of the risk, and the mutual fund management company has basically formed applications or switched to the telephone. Oh, well, I don't know what that might be. Okay, let's hope we're doing okay on that. Can everybody hear me okay? Give me a green check. I got a notice here that we're experiencing network connection difficulties.
You sound fine on my end.
Okay, I'll just keep going then. CNN recently wrote an opinion on the whole fee structure of the mutual fund industry, and they make the case that it's not uncommon in a 401k fund, over the life of that account, more than 30% of your corpus could be consumed just in various fees that are charged. So let's take a look. One of the things I want to get across to you is that we, although we do have classes on traditional technical analysis, stochastics, MACDs, moving averages, fib ratios, etc., we are not big fans anymore of traditional technical analysis. I've spent 30 years studying traditional technical analysis, and I don't know about you, but I think most of you would probably agree. Sometimes it works and sometimes it doesn't work so well. I think part of the reason is you can put almost an infinite variety of studies on a price chart. Our position now is totally different because we're going to use a totally different solution around supply and demand. Look, the institutions are making most of the money in this business. Various reports as measured in published 10Ks by Goldman Sachs show you that they have remarkable profitable trading days. Look at this. In 2011, according to the 10K of Goldman Sachs, 54 of the days, they had 198 profitable days, but 54 of the days they made $100 million of profit trading. If you take a look at some of the other reports that have been put out on Bloomberg about Goldman Sachs, Morgan Stanley, and Bank of America, the majority of their income comes from trading against client order flow. This is the report from the 2012 10K report of Goldman Sachs, which you can get at edgar.com. And they had 153 profitable trading days, and where they made, or 61% of the trading days that year, they made in excess of $50 million profit per day. Now, the institutions are behaving differently, and I want to show you what I mean by this. You and I have been led, we have been taught, everything we've been taught is wrong about trading from the Online Trading Academy perspective. Let me give you an example of what I mean. If you look at any traditional trading book, and they will show you a declining market with a series of red candles, we have all heard the cliche, don't catch a falling knife. And we're recommended to not buy this position, wait for 1 or 2 or 3 candles of bounce, and confirm that the move has stopped falling. Well, let's compare this to anything else you would do in your life. Take a look at this. In your life, if the Samsung Smart TV went on sale the day after Thanksgiving, and it were priced at 50% off, you would rush to your local Costco or Walmart and buy that flat screen TV in the blink of an eye. You are taught in the other parts of your life, when things go on sale, it's time to buy them. So the left side of your brain makes a consumption decision to buy the TV on sale, but the other side of your brain doesn't want you to buy this declining financial instrument. That, by the way, happens to be the euro. But let's take a look at what the Online Trading Academy strategy teaches, and I'm going to show you how we get there in a moment around what we call supply and demand. Price has fallen in this picture on the left into what we call a demand zone. Price has come down to our demand zone, it stopped falling, and before it ever got to that demand zone, we had set an entry to buy 1 unit of the euro dollar pair. We bought it as it touched this proximal line of that demand zone, and it rallied out of there nicely. And we made about $600 on that trade in about 30 minutes, trading 1 contract of the euro. So what we teach with our core strategy at Online Trading Academy is how to think and act like a banker and stop thinking and acting like retail. So how does our core strategy work? Well, let's get into this. Sam Seiden, for years, ran an institutional desk on the floor of the Chicago Mercantile Exchange. He was a clerk. About 20 yards from him was a retail desk where retail order flow was routed, but his desk handled the order flow of major institutions. His job was to organize the order flow in stacks of buy orders on the left side of his desk and sell orders on the right side of his desk. And his job, these are all aspirational, unfilled orders of sellers and buyers. I think most of us know that supply and demand, the balance or imbalance between supply and demand of anything is what moves price. We don't trade news, we trade the impact of news on the supply and demand equation as measured by order flow and price change phenomenon. Now I want you to visualize this desk. Now Sam handled at his desk over time literally trillions and trillions of dollars of order flow and started to recognize some behaviors of how institutions act in volatile markets. What institutions look for in volatile markets are where are the filled and unfilled orders on a price chart. And it became part and parcel of our core strategy to measure the balance or imbalance between supply and demand as measured by order flow in any time frame for any asset class, and it became the foundation of our entry or exit to a high probability trade. So let's define our terms. We're going to buy in the demand zones. I'll show you what they look like in a moment. And a price zone, that is a price zone on a chart where the willing number of buyers exceeds the willing number of sellers. What does that look like? Why am I throwing that term willing in there? I'm throwing it in there because what is a market but an action between two willing participants expressing a preference? One is expressing the preference to buy, the other expressing the preference to sell. We may not know their motives, nor do I care about their motives. I only care about their actions. A supply zone, then, is the obverse of a demand zone. It is a price zone on a chart where the number of willing sellers exceeds the willing of number of buyers. Now, are we guaranteed how many are in those zones? The answer is no. All we can trade and recognize in this strategy I'm about to show you is the probability that the unfilled orders of buyers and sellers and where they're located. So this is about probability and pattern recognition. Now, using these supply and demand zones to determine high probability turning points in the market is what we use to generate short-term income and build and protect wealth. We use the identification of these zones as an alternative to traditional technical analysis. Now, let me show you what I mean by this. Here's a sample of one of our high probability setups. This happens to be trading, a real trade that we took in one of our trading rooms where we were trading the Swiss franc, and these are 5-minute candles. I want you to note that the very bottom down here is not a demand zone. The demand zone is marked in yellow, and the very peak up here is not a supply zone. The supply zone is marked in yellow up at the top. So I'm going to draw a proximal and a distal line to identify my demand zone, and I'll draw a proximal and distal line to define my supply zone. Note that I am drawing these supply and demand zones where price is going sideways, which we would define as price being in equilibrium between those two lines in a very narrow range. Now, in our core strategy, I want you to note here where the yellow zone is in the demand zone. We are not trying to make money in this initial move out of the demand zone. Now, by the way, for you foreign currency traders in this room here, look how fast price moved out of that zone. Again, these are 5-minute candles. Look at the rate of change. At the end of the day, can any of you move price that far, that fast? Probably not. It would probably take a very substantial institution participation pattern to make price move that far, that fast. What our strategy says to do when we see this pattern form here on the left is wait patiently for price to retest our demand zone, measured right here under A. Now, what if price doesn't retest our demand zone? We're going to take no trade. The lowest risk, highest probability trade on the board in front of you right now is to patiently wait for the retest back to the demand zone. So I'm going to buy here in the demand zone. I'm going to sell here in the supply zone. And why am I going to do that? Well, go back and look at the recording of this webinar, and you will be able to see the definition of those supply and demand zones. But where am I going to put my stop? I'm going to put my stop down here at point C, right snug against the distal line of my demand zone. So doesn't it mean if I'm going to buy here as we cross the proximal line of my demand zone, I'm going to put my stop here at C under the distal line of my demand zone, doesn't it mean the distance between these two lines, which give me my entry and my exit, in fact becomes the defined risk on that trade? Yes, it does. But look what my reward potential is. My reward potential is the distance from the beginning of the demand zone to the entry into the supply zone. I want you to note that this distance, if you were to measure it, is approximately 3 to 1. Our core strategy involves us only taking trades that demonstrate to us before we get into them the probability and capability of a 3 to 1 reward to risk ratio. So if I'm going to risk, say 50 pips of risk in the demand zone, I'm looking to have 150 pips of reward opportunity as a target to get out of that trade. Now, an interesting phenomenon, then what are the candles about? In fact, instead of using all these technical indicators and with infinite variety of settings, which are only really derivatives of price and lagging by nature, what our attitude about conventional technical analysis, it doesn't work very well. And all I'm really taking a look at is the historical filled orders. Because what is a red or green candle? It represents the handshake between the buyer and seller. It doesn't tell me a whole lot about the unfilled orders. Under our core strategy, you might want to write this down. The unfilled orders, the aspirational buyers live in the demand zone, and the aspirational sellers live in the supply zone. And we'll talk a little bit more about that in a moment, and we'll talk a lot more about it if you choose to come to one of our free classes. But at the end of the day, our core strategy is based on the probability, the location, and the proper scoring and identification of these two zones. See, what we do in our scoring grid and methodology is that we score these zones 1 through 10, and we only take the trades that score 8, 9, and 10 and give us the highest probability, lowest risk setup with the highest probability of success. I've been doing this for quite a while, and I'm asked all the time, why do you keep doing it? Well, I do it because I enjoy it. And I get letters like this and emails all the time. Thousands of them all the time. And it really, they're absolutely heartwarming to see the nervous novice come in, learn our core strategy, execute it with discipline, and start to receive some high-quality results. Justin recently sent in this one. He said, I just quit my job because I'm making more trading than I make at work. Now, I'm not recommending anybody on this webinar today give up your day job. We're in a global recession. It's going to get worse before it gets better. And what I want you to do is learn part-time how to fit trading into your lifestyle. And do it with the automation. There are many fine broker-dealers out there where you can execute your trades and automate their entries and exits around these high-probability supply and demand zones. Justin goes on to say, I've been trading the early morning hours, making $300 to $500 a day. I look forward to being able to spend more time with my wife and son. Many thanks to the instructors and coaches at OTA. I'm up $450 already this morning. I think I'll call it a day. It's 8:45. That's the greatest kind of email I can get. Now, what do you think this guy's going to do with the rest of his day? Well, he's going to do what's important to him. And that's why I asked you when we started this, What is your why? Why do you want to learn to trade? What is your aspiration? How will this change your lifestyle if you could acquire these skills and fit them into your lifestyle? All right, let's take a look at a few trades. The concept here of supply and demand that Sam has brought to us is categorically genius in its simplicity. You know, I make it the equivalent of a smartphone. What is a smartphone? Well, it's a $500 mainframe computer in your pocket for less than $500 that gives you the capacity to communicate with 1 billion people at the speed of light with a one-button operating system. That's genius. Well, the Online Trading Academy course strategy, as measured, developed by Sam and our team of 80 instructors, and enhanced with our odds enhancers, is pure genius. It's genius in its simplicity to organize in a disciplined way a strategy where you can find and score high probability trade setups without learning at crazy technical analysis. Okay? So let's take a look at this. Let's call this your favorite trade. Whatever this you're a currency trader, a stock trader, a futures trader, and this is your favorite time frame. So those candles get to represent whatever time frame appeals to you. If you're a day trader, these are 10-minute candles. If you're a swing trader, these are one-day candles. If you're a position trader, these are one-month candles. I don't care. You make it whatever you want, but let's identify the location of supply and demand. Let's take a look at this. Price is going sideways here on the top left. We call that supply. We wrapped as because price is going sideways because supply and demand are in equilibrium. The origin of the move is right here, out of that supply zone, and these big 3 red candles drive price lower. Why did price decline? It could have been impacted by news, but we don't trade news. We trade the impact of news on price. We know that price left fast because of the size of the candles. We call those expanded range red candles. Since they're red, we know that the sellers overwhelmed the buyers or price would have not declined. But where did price decline to? It declined to a lower price zone where, look what happens. Supply and demand comes back into equilibrium. Now, I want you to note in our core strategy, we're not trying to make money on the origin of this move. When this price moves from the origin of the supply zone down to the demand zone for the first time, we're not trying to make money there. We're going to patiently wait for price to come back and retest our supply zone, and look what it did. Now, notice something very unusual here, and happens quite frequently in our model. Notice when we get the retest back to the supply zone after a speedy movement of price into or out of a zone, that price did not go very deep into the zone on the retest of the, and it didn't stay very long until this big red candle drove price right back down to the demand zone. Why did that happen? Well, under the Online Trading Academy logic, it happened because when the price left the zone in the origin of the move, not everybody who wanted to sell got their order filled. And what Sam observed in behavior of the institutions is that when price leaves a zone or enters a zone quickly, that they don't chase price. They wait for price to come to the zone where they desire to buy or sell. And that really separates them from the general public, if you think about it. Because the public is always chasing price. So I have a choice here. I can short sell this on the re-entry into the supply zone, or if I miss that trade for some reason, I can wait for it to retest my demand zone that down here at the bottom on the right that very well may be the lowest risk trade on the board, and go ahead and buy it in this demand zone and enjoy the profit up. But let's look at this in another way. When price retests back to that supply zone, if the institutions are selling there to create this big red candle to drive price down because they didn't get their order filled because the price had left too quickly for them to get their order filled in the origin of the move, who's buying here? If the institutions are selling, who are they selling to? Well, unfortunately, they may be selling to you as part of the nervous novice herding public chasing price into a supply zone. Now, why does the public do that? Well, they don't know that there is a supply zone there. They don't know how to measure it. They don't know how to score it. And they're expressing their emotions thinking that they have a beautiful breakout trade. So what's the public doing? Well, they're buying after a rally in price and then selling in disgust after a decline in price right here to an institutional buyer, and then they're walking around shaking their heads saying, see, I knew you couldn't learn to time the market. Well, if you don't know how to identify the high probability supply and demand zones, it's extremely difficult to time the market. Now, on this last trade we looked at with the Swiss franc.
Hey, John, I don't mean to interrupt you here, but we got about 2 minutes left.
Yeah.
Okay, cool. Thank you.
All right. Let's end on this. When I re-entered this trade here on the Swiss franc, I want you to know that the distance between these two lines in the demand zone was about $200 of risk, and the distance between the supply and demand zone was about $900 of reward. Now, I want to recommend that all of you, I'm going to scroll through here and show you a whole bunch of trades we didn't have time to get to, but I want to invite you to a free seminar at Online Trading Academy. We have 36 brick and mortar training centers all across the world, and we will show you literally thousands of these trades. They're all documented. They come out of our real trading rooms. We host about 10 different trading rooms. This is one trading room where we have 20 different asset classes posting before the market opens each day, 3 levels of supply and 3 levels of demand. So I've enjoyed being with you. My name is John O'Donnell. My call to action is come to a free class at one of our centers near you. Go to Online Trading Academy, and we got a free newsletter there. We have a radio show called Power Trading Radio. Got about 500 hours of free content there. Just look for it on our website. God bless you all. Good luck. If you have some time, I'll be happy to answer any questions you might have.